When it comes to price action, there's mainly three major concepts that are absolutely crucial. The market structure is the first one, and without making the definition too long, the market structure is the way a market is moving. If we know the way a market is moving, then we know their swing points, which is the second concept. The swing points are the highs and the lows of a market, and knowing the swing points will help us identify the trend direction, which is the third concept. I'm sure you've seen this type of price action. This is a market structure of an uptrend. The reason we know it's an uptrend is because of the swing points. An uptrend is defined as a price that's repeating this pattern of higher lows with higher highs. The push is to the upside and is usually the more aggressive or impulsive movement, and the target of this impulse is to break above the last high. Now, after the impulse, we have a pullback. That pullback on an uptrend is a downside movement, but this pullback should not break below the last low, but it needs to end above it. So we have a push to the upside, then a pullback to the downside. And what holds the uptrend is the repetition of this pattern. Then we have the other trend, which is a downtrend. The downtrend is a market that is having repeated swing points of lower highs that are then followed with lower lows. The downtrend is literally just the repetition of this price action pattern where the push is to the downside, and that forms a low, then the pullback is to the upside to form a high. And as I said, this pattern repeats, so from a high, which was formed from a pullback, the market pushes back down again, and this important part of this push is that it needs to break below the last low. And somewhere after the break to the downside, the market will eventually pull back to the upside. But this pullback should end lower than the previous high, so it can form a lower high. And a key note to remember is that the downtrend is this repetition of this lower high and lower low pattern. The market can't hold an uptrend forever, and eventually the past low, which was a higher low, will break down. When this happens, the market creates the first lower low swing point. So you can notice how before we had higher lows, which were swing points of an uptrend, but the moment the price breaks down the last swing low and creates the first lower low, that first break is a huge sign of a trend reversal, a reversal into the trend that has the most recent swing point created from the break. So if the lower low was the first swing point after the break and a lower low is a swing point of a downtrend, this shifts the previous trend, which was an uptrend, into a highly likely upcoming downtrend. That's why the first break is called a trend change, market structure shift, or change of character. They're all the same thing and same concept, just under a different name. And what we must know is that after the first lower low swing point, since the trend reversed into a downtrend, the chances are for the price to follow a price action of a downtrend. And that is a lower high, which is a pullback to the upside that must end below the last high, followed with a lower low, which is the break of the last low. Basically a push to the downside to break the last low, forming a lower low, and then a pullback to the upside to create a lower high. And a downtrend is just the repetition of this pattern, as I've also said before. Now also, a downtrend won't last forever. Eventually the price will break above the previous high. The previous high on a downtrend is a lower high, and so if the price breaks above it, then the market creates a higher high. And when the market was in a downtrend and we get the first higher high swing point, this shows that chances are for the trend to shift into an uptrend. And an uptrend has swing points of a higher high, which we already have right here. That should then be followed with a downside pullback to form a higher low swing point. So basically this pullback needs to end above the last low, forming a higher low swing point. And since the market has entered into an uptrend, the uptrend keeps holding as long as this pattern of higher highs with higher lows keeps repeating. So now you know that the market is always trending, be it on an uptrend or in a downtrend. Now let's see on an actual candlestick chart. And just by looking at it, you can tell that this is a downtrend since it's been going down over time. But we don't stop there, and we must prove it. We can know what trend a market is following from the swing points the price action has been forming. And in order to know the swing points, we must analyze the way the price has been moving. We do that with a directional analysis. It might sound fancy, but it's literally just connecting one swing point to another. And then we look at the swing points and carefully analyze them. Here from the beginning on the left, the price begins to fall down from a high into a low. From this low, the price is going up, ending on a high that's lower than the previous high, and from this last high, the recent one, the price pushing back down, ending on a low, and this low breaks below the previous low. So from these last two movements, we got a lower high, and then a low that is lower than the previous one, and that is a lower low. So now the market has confirmed a lower high that is then coupled or followed by a lower low, and it's only when we have these two downtrend swing points, when we can truly say that the market has entered into a downtrend. And if you remember what I said at the beginning of this video, a downtrend is a market that repeats this pattern of a lower high, followed with a lower low, and so if it keeps these swing points, that means that from this recent low, the expectation is for a lower high. And a lower high on a downtrend is a pullback to the upside that cannot break above the last high. And so it must end below the last high before eventually pushing back down into breaking the past low, with the new low also ending lower than last one. So as I said from the theory, the downtrend is active as long as it repeats forming the swing point of a lower high that is then followed with a lower low swing point. And that's what it does again. From the swing low, the price is pulling to the upside, this pullback ending on a high that's lower than the previous one. After the upside pullback ends, the price is going down into breaking below the last low. Well, because that's what is expected to happen on a downtrend, for the previous lows to break down. And these last two movements leave us with a lower high that was then followed with a lower low. It's what also happened shortly after, because we see that from this recent low, we get another smaller upside pullback, ending below the last high. Then it starts pushing down again so it can break the last low. After the break, we basically validated that we had a lower high with a lower low. And now we're having the last pullback to the upside, the most recent one. And we also see that the last candle is a bearish rejection candle. So there are quite high chances we will now have this price pushing back down to break the past low. So the market can continue the formation of a lower high swing point that is then followed with a lower low swing point, basically a downtrend pattern. So the analysis is pretty much done. Now the question is, what's this analysis being used for? Why is it so important? Well, if we know that we are in a downtrend, and we also know that a downtrend has swing points of a lower high coupled with a lower low, so a bearish market, a market that's going down. On such market, it makes sense to look for selling setups. But from where? We do so from supply or resistance levels. These supply or resistance levels are found on most of the highs during downtrends. So let's look at the first one from the left. And where exactly is that supply? It is the last upside candle before the market started the push to the downside, and this is the first supply we found. And you will see many times that an upside pullback will fill into these supply or resistance levels, somewhere inside of it, and then the price will usually push down from them into breaking the last low. So these supply or resistance levels gives us an opportunity for a sell setup down from them. We're also going to get into the planning of the setup, don't worry about it. But for now, we need to make sure everyone understands the basics. Let's look at the next high. The supply is the last upside candle before the price started pushing to the downside, which is this level right here. And see that in this case, the market did not fill this supply. That's completely normal, since not every supply or resistance will fill or even respect. So if the price doesn't get to hit into the supply or resistance, then we just skip it. It's that simple. We do nothing about it and look for the next one, which, as I said, they're found on the highs. And if we look at the next high, and more specifically on the last upside candle before the market started to push down, that entire candle is the supply or resistance level, which in this case it did respect since the price pulled back up, has filled the supply, and then it pushed down, breaking the previous low, and guess where the price is sitting right now? Exactly on a supply taken from the last high. So now that we have practiced a bit, we get into another example, and this time we are going to look for a setup. Similar as on the previous market, from a straight look at the direction of the price, we can tell this is a downtrend, but that will not help much. We need to know every detail because it's easy to just look at this price that's going down and tell you to just look for sell setups, but then more questions should be asked. For example, where to look for these setups in the first place and how the take profit and stop loss targets are being placed. So exactly where to exit from a position, because these targets are not random. So that's why the price action analysis is actually most of the work. So let's begin from the very beginning, on the left of the chart so we understand what is going on. The first thing we do is to connect the swing points, from each swing low to each swing high. This will help us know the direction of the swing points. And after we finish connecting the swing points, we must read and analyze each of them. For example, right on the beginning of this market, on the left of it, we start from a low that pushes into a high. From this high, the price is then falling down, breaking below the last low. So if it breaks below the last low, that means that we've got a lower low swing point. From this lower low, the price pulls back to the upside, this pullback ending on a high, from where the price then continues pushing back down, with this downside push breaking the last low once again. So this downside break validates that the last two swing points were a lower high. So basically a high that has ended below the previous one, then it was followed with a lower low. So now we're in a downtrend, and a downtrend is literally a repetition of these two swing points. So if it repeats them, that means that after a lower low, we will probably have a lower high. So it can then push down and break down the previous low. And after the break, we pretty much have a confirmation that these last two swing points were a continuation of a downtrend, since we have the recent high being lower than the last high, while also having the recent low being lower than the last low. And from this recent lower low, the price again pulls back up and ends on a high. After this high, the price again is pushing back down so it can form a low. But we see that, in this case, this low could not break below the last low, and it actually ended higher than the last low before going up again to form another high. Let's explain what just happened. So we need to carefully look at the recent swing points. So from this lower low, we got an upside pullback that ended on a lower high. After that high, the price created a low that ended higher than the last one. So this is the first higher low swing point we had on this market. And as you should know, the higher low is a swing point of an uptrend. So does that mean that the trend just started an uptrend? And the answer is, not really, because we did not see a break above the last high, and that's what we needed for a trend change into an uptrend. Here, what happened is that it has created that higher low, so it gave the first sign that the trend might soon be looking to shift into an uptrend, but it has failed since the price, instead of creating a higher high, it has created a lower high that was then followed with a lower low. So it actually kept holding the downtrend pattern since it has broken down again below the past lows. Now from this last lower low, we have an upside pullback, and what's interesting about this pullback is that it finally breaks above the last high, and the last high being a lower high, if now it has broken above it, that means that we got the first higher high swing point. Now, when the market was previously forming lower highs, and then the price breaks above the last high, that first break is what shifts the downtrend into an uptrend. It's basically a sign of trend reversal, because the market is finally starting to print an uptrend swing point, which is the higher high. And as we know, on uptrends, after a higher low should be the next swing point. The higher low is a downside pullback, but this pullback needs to end above the last low so it can end as a higher low swing point. Then if you know what swing points an uptrend does repeat, then it shouldn't be a surprise to expect that after a higher low, a higher high would be the next swing point. And a higher high is seen as a push to the upside that breaks above the last high. Now if you know that eventually this has a high probability of happening, where would you look for a potential setup? It might make the most sense to follow this upside momentum with a buy setup, but from where? What we need to know is that the higher lows will often end on a demand or support, and this demand or support is found on the previous low, and that level more specifically is the last downside candle before the price started going up. The buy setup's entry is placed on the top of the demand level. The stop loss is placed below the last low. The logic of this placement is that we don't expect a lower low on an uptrend, and if it actually does happen for the last low to break down, then the chances are this trend is going to reverse again into a downtrend. And with this placement, we basically get out of the setup taking the smallest loss we can. So that's the logic behind it. And the take profit, since we expect a higher high on an uptrend, a logical placement of the take profit should be somewhere above the last high. I would target for at least 1-to-2 ratio. So the price continued to go higher for a bit, and then it pulled down and hit the demand. This means that the buy setup is now opened. It begins the bounce to the upside, and this bounce leads into breaking above the last high, closing the setup on the take profit target. So all we did is to notice that the trend has reversed its swing points after forming the first higher high, then we just followed the trend since we know that after a higher low should be the next swing point, which was the swing point that ended on the demand level, and after a higher low, a higher high should be the next swing point of an uptrend. And that was this last push to the upside that managed to hit the take profit target. Now let's jump into another example, and remember what we start with. It's always a directional analysis. We basically connect the swing points from each swing low to each swing high, and from each swing high to each swing low. And after that's done, we mark out the swing points from the beginning of the price action. And on this market, we start from a low that pushes up quite significantly, ending on a high. From this high, the price pulls back down, and then it starts pushing up. This last upside movement did break above the last high. So after the break, we have a confirmation that the market pulled back down on a higher low. This higher low was then followed with a higher high. So these are swing points of an uptrend, and on an uptrend, after a higher low should be the upcoming swing point. And that higher low is a downside pullback that ends above the past low, before turning again into pushing above the last high, with the break above the last high validating that we had a higher low that was then followed with a higher high. From this higher high, the price is pulling back down and we're looking for the price to form a swing low. and this swing low needs to end above the last low for the uptrend to keep going. So we're looking for a higher low swing point. So basically for a repetition of the uptrend swing points. On uptrends, the price is ending on higher low pullbacks that are then followed with higher highs. Basically a push to the upside that breaks the last high. So if we expect this price to keep going up, then we can look for a buy setup. And the buy setup is planned from a demand or support level. And that level is found on the previous low. More specifically, it's the last downside candle before the price started pushing up. And this should be the demand or support level from where we can position a buy setup on its top of the demand, with the stop loss below the previous low because on uptrends, a lower low should not be expected, and the take profit above the last high, since on an uptrend, a higher high is expected. Now in this case, what actually happened is that the price couldn't sustain a higher low swing point, and the price breaks below the last low. Of course, this closing the setup on the stop loss and invalidating this demand since the price broke below it. In this situation, most would get mad because of a losing setup, and that's fine. However, what's not alright is to only look at the lost setup and not what caused it, and what other opportunities can come up next. For example, when the price breaks the last low and it turns it into the first lower low swing point, the break of the last low into this recent lower low signals a trend shift from an uptrend into a downtrend, on a downtrend after a lower low swing point. The next one should be a lower high, and that's an upside pullback that can't break above the last high, but must end below it before it continues the downtrend by pushing down and breaking the last low. So pretty much a lower high expectation that is then followed with a lower low. That lower high will usually end on a supply or resistance, and that supply or resistance is taken from the previous high. That level is the last upside candle before the market started going down. And it's on this supply where we can plan a sell setup, with the stop loss above the last high, since on a downtrend we don't expect a higher high, and the take profit below the last low, or close to it, since we're expecting a lower low swing point on a downtrend. And the downtrend kept going without hitting the supply. So that means that the upside pullback ended below the supply, and that didn't open the setup, but still ended below the last high before it pushed down, and that breaks below the previous low. So it kept the formation of the downtrend swing points. That's a lower high on the pullback and a lower low on the downside break. This gives another opportunity since we know that after a lower low, a lower high should be the next swing point. And that lower high will often end on a supply or resistance that was formed from the previous high. So we look at the previous high, and more specifically on the last upside candle before the market started pushing back down, and that's the recently formed supply or resistance level. And we try again with a sell setup from this supply, with the stop loss above the last high, and take profit below the last low or close to it. The price pulled back to the upside, this time filling the supply and opening the sell setup, from where the price then started pushing down, with this downside push breaking below the last swing low. So it kept this downtrend pattern of a lower high from the pullback that was then followed with a lower low, with this last low closing the sell setup on the take profit target. Now I highly suggest you watch the last video as well, because that's where we get in depth into the internal price action as well. On this video I tried to simplify the external price action as much as I could, but of course there's more to it. And you also have my program on the description if you want to take a look at it. But for now, see you on the last video.